Have you ever opened a company's annual report and just felt your eyes immediately glaze over? Yeah, it can feel like you're trying to read a completely different language. But what if I told you that a financial statement is really just a health report for a company? It tells you if it's thriving, if it's just kind of getting by, or if it needs some serious help. So today, we're going to learn how to read those vital signs together.
Right? Words like these, they can make a financial statement feel like this locked book you're not supposed to open. The language seems so complex, so intimidating, like it's only for accountants and Wall Street analysts. But here's the thing. Understanding these reports is the key to unlocking the real story a company is telling about itself.
And that's the big question, isn't it? Look, this isn't about becoming a financial expert overnight. It's about learning to ask the right questions and knowing exactly where to look for the answers. And in this explainer, that's what we're going to do. We're going to break it all down into simple, manageable pieces.
Okay, first things first. To really understand the report, we need to know who it's for, because the way you read it depends entirely on what you're looking for. Think about it. A doctor, a patient, and a hospital administrator all look at the same medical chart, but they see completely different things, right? It's the exact same idea here. And it turns out, it is a very crowded room. You've got investors who are searching for growth. You've got creditors, like bankers, who just want to know if they'll get their money back. And you have the managers themselves trying to steer the ship. Even employees in the government have a stake in it. Every single one of these groups is looking at the same set of numbers, but they are all asking very, very different questions. So to keep things nice and clear, we're going to focus on three key perspectives. First up, we have the investor, and their main question is all about profit and getting a return. Second, the banker, who is all about risk and stability. And third, we have the manager, who uses these reports almost like a report card for their own performance.
Let's start with the investor. You know, whether you're a seasoned pro or you're just buying your very first share, your fundamental question is always the same. Is this company going to make money for me? And that all comes down to one single word: profit.
To measure this, investors use something called profitability ratios. Think of these like a set of diagnostic tools. They don't just look at the raw profit number on the page. They measure how good the company is at turning all of its sales and all of its assets into actual tangible income.
Now, one of the most powerful tools for an investor is, believe it or not, surprisingly simple. It's the net profit margin. You just take the company's net profit after tax and you divide it by its total sales. The result answers a really simple question. For every single dollar of sales the company makes, how many cents are left over as pure profit after all the bills are paid? It's a fantastic direct measure of a company's pricing power and its cost control.
And this illustrates perfectly what that number tells you. A high margin suggests the company is running a really tight ship. It controls its costs well and can charge a good price for what it sells. A low margin, on the other hand, that could be a red flag. It might point to high costs or maybe some really tough competition. For an investor, a healthy margin is a very, very good sign.
All right, let's switch hats now. Our next reader, the banker, isn't really focused on explosive growth like an investor is. No, their primary concern is much more cautious. They're thinking, if I lend this company money, am I going to get it back? This is a question of stability and risk.
To figure out this risk, bankers turn to gearing ratios. Now, gearing is just a financial term for leverage. It measures how much of the company is funded by borrowed money, that's debt, versus how much is funded by the owner's own money, that's equity. It's a classic balancing act.
This visual makes the concept crystal clear. A low-geared company, Company A, relies mostly on its own money, which is a whole lot safer. A high-geared company, Company B, is using a lot of debt to fuel its operations. Now, this isn't automatically a bad thing, but it definitely raises the stakes.
And this right here reveals the crucial trade-off. High gearing can seriously amplify returns for shareholders when things are going well, but it also amplifies the risk if things go south. From a banker's perspective, a low-geared company is a much, much safer bet. They care more about surviving a storm than they do about shooting for the moon. Okay, finally, let's step into the shoes of the manager. They're using these exact same financial statements to look inward. For them, it's a report card. How well are we actually running this business? Are we using our resources effectively?
And this is where efficiency ratios come into play. These are all about operations. They track how quickly the company is turning its inventory into sales, its sales into cash, and just how well it's managing its overall assets to generate that income. It's all about being lean and effective.
A great way to visualize this whole thing is with the cash operating cycle. It basically tracks the journey a single dollar takes through the business. So first, the company spends cash to buy inventory. Then, that inventory is sold to customers. Next, the company has to collect the cash from those customers. And finally, it uses that cash to pay its own suppliers.
And here is the key takeaway for any manager. The shorter this cycle is, the better. A fast cycle means cash isn't just sitting around as inventory on a shelf or as an unpaid bill from a customer. It's flowing, it's working, and it's generating value. A short cycle is the sign of a very well-oiled machine.
So, we've looked at profit, stability, and efficiency. And you might be thinking, great, I've got it all figured out. But this is where the real analysis begins. Because the numbers on a page never, ever tell the whole story.
I love this quote from our source material because it's probably the most important lesson of all. A ratio is just a number. It only becomes meaningful when you compare it to last year's number or to a competitor's number, and you start asking why it is what it is. Context is absolutely everything.
And you have to be critical. You have to remember that these numbers are based on the past, not the future. They completely ignore crucial factors like the quality of the management team or employee morale. And maybe worst of all, they can be manipulated. There's a practice called window dressing to make a company look a lot healthier than it really is.
So, the next time you look at a financial statement, don't just see the numbers. See them as clues in a detective story. Look for the patterns, ask the tough questions, and always, always wonder, what story are these numbers really trying to tell me?